So I did just want to give you a quick update on some current APRA issues, but also comment a little bit on some of the challenges that lie ahead for the superannuation industry and for trustees, because there are some unfinished regulatory reforms to complete and bed down, as I know you're all aware, but it is also, I think, important that industry keeps its focus on the achievement of longer-term goals and, importantly, providing adequate retirement incomes to super fund members. And there are clearly some important issues for the industry to tackle in the near term in order to do that. But let me start firstly with a few current issues. So, prudential standards. Obviously, you should all be well aware that there's the new framework that came into effect from 1 July, and the industry has really taken a very constructive approach to the implementation of these standards. Our focus in our supervision activities has been, and will continue to be, on the effective implementation of the prudential standards. This is important because it will allow us to assess how well the frameworks and policies that have been developed to meet the new standards are supporting sound governance and risk management across all areas of trustee operations. And after all, that is the objective of the standards. APRA's adopted a soft or facilitative approach to date, but we are now moving to take a firmer stance where we expect trustees to substantially meet the requirements of the various standards. So our conversations with you are likely to be a little bit stronger and firmer than they may have been 6 months ago, where we see practices falling short of expectations. Of course, we will continue to be principles-based and outcomes-focused in our approach, and we acknowledge that there's a need for exercise of judgment in assessing how the standards are met in practice. We've commenced our thematic reviews on implementation of 2 of the new standards, conflicts of interest and insurance management, but that doesn't mean that we are not taking an active interest in other areas. We will continue to undertake our normal reviews and other activities looking across all areas of your operations, and in fact, often the thematic reviews will be done in conjunction with these normal supervisory activities. We are, as I said, looking at other areas. So, for example, we're in the very early stages of an accounting risk review, which is similar to the reviews we've undertaken in other APRA-regulated industries, where we're looking at financial statements with a particular focus on areas that might be of prudential concern or interest. And in super, for example, that might be valuation of illiquid and unlisted assets and how they're accounted for. We will provide feedback to industry, both bilaterally and on an industry-wide basis, on the outcomes of the thematic reviews that we undertake, highlighting areas of better practice, but also areas where there's room for industry practices to improve. For MySuper, the authorisation process is now substantially complete, and so again, we're focusing on implementation issues. Our view is that the authorisation process went reasonably smoothly, and much of that was due to the generally collaborative approach between trustees and APRA. There have been some media reports suggesting that everyone that applied for authorisation was waved through by APRA, and I can assure you that was definitely not the case. APRA worked with trustees who submitted and often resubmitted draft applications. Many applications were withdrawn to address issues that APRA identified, and not all of those applications ended up being resubmitted. So given all of the work that was undertaken behind the scenes, it should not be surprising that the final applications we received were generally of a very high standard and so were able to be approved. Having said that, we are continuing to work with trustees to ensure that they address those areas of their operations that were okay to get them over the line, but not where we would ultimately like them to be. We are also undertaking follow-up work to ensure that funds that do not have a MySuper authorisation do not accept default contributions. We have identified a few such cases that we're seeking to have addressed as quickly as possible. So going forward, we will expect to see trustees of MySuper products delivering on the commitments that they made as part of their applications, particularly in terms of net return to members, risk return objectives, the fees paid by MySuper members, and the plan for transfer of accrued default amounts. The other substantial area of focus in the last 12 months or more for both industry and APRA has been implementation of the new superannuation data collection. And APRA would commend the industry for its efforts to date, as it is clear that the vast majority of trustees and particularly service providers are working hard to meet the new reporting obligations and improve the supporting processes for gathering and reporting information to APRA. We think this will have benefits down the track for trustees and funds. After all, the data that APRA is seeking is information that should be of relevance and value to trustees in managing their operations and meeting their obligations to members, and so it's important that that information is available to them in a timely manner. Nevertheless, we have continued to receive feedback from industry on the level of reporting burden, particularly in relation to submission timeframes and the volume of data to be reported for the upcoming select investment option quarterly reporting. So hopefully you will all have seen the letter that APRA issued on Friday confirming the granting of transitional relief for the due date for quarterly returns for the next 18 months, so that data is required to be submitted within 35 calendar days after the end of the quarter rather than 28 days. Deferral until 1 July 2015 of the commencement date for quarterly select investment option reporting and the additional data proposed to be collected by the ABS, and further consultation on the content of the quarterly select investment option reporting and additional ABS data, and we hope to undertake that further consultation next quarter. We also released a joint APRA ASIC letter last Friday seeking to clarify the application of Section 29 QC, which addresses the linkage between APRA reporting and APRA disclosure ASIC disclosure obligations in some key areas, and in particular, which types of information will be required to be calculated in the same way for both purposes. Our early analysis of the data that has been submitted for the first 2 quarters has raised a number of data quality and consistency issues, which we will be addressing either with specific funds or through FAQs or other guidance. And in that vein, APRA is planning to release in the next few days some minor updates to 6 of the current quarterly reporting forms and instructions that incorporate issues currently addressed in FAQs. Our challenge when we consult further on the select investment option data collection in a few months' time will be to ensure that in revising the proposed data collection, we strike the appropriate balance between the data to be provided and the cost and effort for industry in reporting it. While it is clearly important that we are cognizant of the issues faced by industry in meeting the revised requirements, it must also be remembered that there have been calls by industry and other stakeholders for a few years now for a significantly enhanced APRA superannuation data collection and publications. We clearly need to ensure that the revised data collection provides sufficient information to meet APRA's needs from a prudential perspective, but it also must meet the needs of other industry stakeholders, particularly given the transparency objective that underpinned the stronger super reforms. So it will therefore be critical that industry engages constructively with APRA in this next phase of consultation so that we can strike the right balance in meeting the needs of different stakeholders. I should also note that APRA is undertaking broader work to review the cost and compliance burden on all APRA-regulated industries, consistent with the government's deregulation agenda. And so we are seeking to engage with industry over the coming months to identify other areas where there may be scope to reduce compliance costs without compromising sound prudential outcomes. On SuperStream, I'll just mention that APRA is working closely with the ATO on implementation. As we did with rollovers, APRA will take a facilitative approach in relation to implementation of the data standards for contributions. There'll be a phased transition in approach, and breach reporting will not be required until after 31 December this year. Also, just a reminder that the APRA part of the data collection that will support the government and ATO assessment of the benefits of SuperStream via reporting form SRS 711 commences with effect from 1 July 2014 as planned. So I've spoken so far about some of the more operational issues with which industry has been grappling. Let me now turn to be a bit more forward-looking. There are many strategic issues currently facing the superannuation industry. One is insurance, where there is a need to tackle some complex issues to ensure a sustainable approach into the future for members, for funds and for insurers. The issues in insurance relate, for example, to design, to pricing, to claims management, to contract terms. They involve risk issues, equity and affordability issues, and they will be challenging for trustees to get right. Similarly, in the area of investments, there are strategic decisions to be made on how investments are structured and managed, for example, what is undertaken in-house versus outsourced, and the options and products that are offered. For example, should you provide a life cycle option, and if so, what should it look like? What direct investment options should be offered to counter the potential loss of members to SMSFs. Again, these raise many issues for trustees to consider regarding what is appropriate and why, whether they have the skills and capabilities to understand and effectively implement and monitor what they put in place. And of course, another area that warrants focus by trustees is the post-retirement phase and the issues it will present. These include implications for liquidity and investments as more members move into this phase, as well as the investment or product options that could or should be provided, for example, to help members manage longevity and investment risk. In many cases, these options will require trustees to partner with others, such as an insurer or other service provider. APRA encourages trustees to be innovative and strategic in their approach to addressing these and any other areas and challenges. However, APRA also expects trustees to always focus on their obligation to act in the best interests of members and to undertake a rigorous and comprehensive analysis of all of the risks and issues that will be involved in taking a particular approach or path. We will expect to see a soundly based rationale for the decisions that are made that clearly articulates how the particular approach is justified in the context of the best interests of members and how it fits with the trustees' risk appetite. We will also expect to see implementation plans that are sufficiently robust and detailed and that seek to ensure that the innovative ideas are effectively translated into practice over a reasonable, i.e. not too short, timeframe, with all material risks appropriately managed. I should also stress the importance of engaging with APRA early in the planning phase when looking at major strategic changes such as those I've touched on. That enables any possible prudential issues to be identified and addressed well before the implementation stage, which is only to everyone's benefit. Data integrity comes to the fore in dealing with many of these strategic issues. Having adequate and high quality data is increasingly integral to many facets of trustees' operations. Robust and effective data systems will provide key advantages to trustees that use them well. They will help you better understand your membership and hence to increasingly tailor benefits, services and communications. And that will be important to member attraction and retention and hence the achievement of scale efficiencies. And who knows, it might even help with member engagement. Importantly though, robust systems that support data integrity are needed to ensure that you're able to deliver on your member best interest obligations, for example by effectively and accurately managing and monitoring contributions, investments, insurance and benefit payments. So in setting strategic plans, trustees should be putting as much emphasis on getting their underlying systems, processes and reporting right as they do on the more innovative aspects of the benefits and services that they offer to members. And finally, the role and capabilities of the board are key in effectively managing innovation and change. To that end, it is important that board skills and performance are regularly assessed and renewed to ensure they keep pace with industry developments. APRA will, as always, take a keen interest in how this is being done across the industry. So let me end with a message of encouragement for the industry to work together to tackle the challenges that lie ahead. Doing this successfully will require all parts of the industry, trustees, fund executives, service providers, regulators and the government to cooperate and collaborate with goodwill and a clear focus on the end goal. There should be alignment of purpose towards the objective of achieving adequate retirement income for super fund members, even if there are differences of view on how we get there. It's important to the reputation and credibility of the industry with its key stakeholders that the focus is on finding common ground and a way forward on issues wherever possible, with a view to ensuring the industry as a whole achieves its important retirement incomes objectives. Thank you.
There's a number of things that I want to talk about today. Obviously, disclosure for ASIC is a key area of concern. And in particular, I want to talk about some of the reforms that are already here, like the product dashboard, but also some of the reforms that are coming fairly quickly, executive officer remuneration, systemic transparency and reforms such as these. I also want to talk a little bit about what the future will hold and ASIC's approach as we go forward. One of the things that Tom specifically asked us to address was where we think the industry will be in 5 years' time. And obviously, as a regulator, some of the big policy calls are not ASIC's call to make, but I will try to explain where I think there are some opportunities, where I think we might be heading in 5 years' time as we go through. Let's start with product dashboards, because product dashboards, certainly for My Super, are here at the moment. These reforms started on the 31st of December last year. The product dashboard is a quick piece of snapshot information about a superannuation, My Super fund, that looks at risk, returns, return targets and fees. I'm sure everybody here is well aware of this. Its substantive content is in both the regulations, the law, and in APRA's reporting forms as well. Late last year, ASIC published an info sheet on the product dashboard, and it included with it a mock-up example of the product dashboard that partly came from some of the consumer testing results that we had late last year too. Judging by our reviews so far, it looks as though the mock-up dashboard has been quite popular. Many of the trustees seem to be using, if not that example, then at least a variation thereof, which is very positive to see. You'd also be aware that late last year, at the same time as we delayed the start dates for the fee disclosure regime, this is in Class Order 13-1534, we also put some interim relief out there so that you didn't have to provide a hard copy product dashboard with your periodic statement. I want to speak a little bit about the consumer testing, because I think the consumer testing is quite interesting in terms of looking at where this starts from. The consumer testing was undertaken by some independent researchers, Latitude Insights, and their report is available on our website as Report 378. It's well worth a look. The research was generally positive about the product dashboard. Consumers felt that the dashboard really did provide an opportunity for them to engage with their superannuation and make comparisons between different superannuation funds and products. However, like anything, there were some caveats to this. And in particular, the message that came through loud and clear was that we need to keep the product dashboard fairly simple, to keep it jargon-free, to keep the graphs simple as well. The minute it becomes complicated, people tend to disengage and switch off. The other thing that I found particularly interesting is that the two elements that consumers really rely on in getting information about a superannuation fund, it tends to be focused on return and it tends to be focused on risk, or a combination of the two. And I think that's worthwhile thinking about when you're designing your own dashboards. The other feedback that the consumers gave is that they particularly like tailoring. And I think we're now seeing a generation of people who are very familiar with calculators, whether in the super space or whether it's home loan repayments. They're familiar with the concept of being able to put in details into a calculator and work out some information for themselves. So particularly in relation to fees, we got feedback through the consumer testing that consumers would like to be able to plug in roughly their account balance and see what the fees are for them. Now, obviously, there are some logistical issues associated with that. The other thing that the consumers particularly like the idea of is having some comparative information about fees. So, for example, if you know that your fees are, say, $500 a year, having some information as to whether that is average or expensive or at the lower end of the scale would be very useful. In and of itself, that information doesn't tell consumers very much if you just say the fees are $500. And as we go forward with APRA's data collection, it may well be possible to put some of this information into the product dashboard in the future. So ASIC has started looking at some of the product dashboards, and I don't mean by saying this to cause any unnecessary panic that we are taking a heavy-handed approach or anything like that. What we do want to do, though, is we do want to see how the regime is bedding down, and actually so far so good, as far as we can tell. There are, as with the consumer testing, a few caveats. There are a few things that are coming through in the initial reviews that I thought it would be worthwhile sharing with you. Just a few things that perhaps need some further thought and perhaps some further guidance from ASIC in the future. In some cases, we found the product dashboard very hard to find on a website. And in fact, in one instance, we had to contact the trustee and ask them to send us a link. It was there. It's just it wasn't easy to find. If you look at the product dashboard as a tool to help members make comparisons, and perhaps it's the one way that they do engage with super if they're not reading their PDSs, if they can't find the information on a website, that's probably not a helpful start. The other thing that we found was that in about 3/4 of the cases, the product dashboard had either additional information in the dashboard, around the dashboard, or a combination of both. And mostly this was information to do with asset allocation or additional information around risk and fees. And while by and large the trustees that we saw hadn't done anything wrong with this, it was appropriate, it wasn't misleading, I think there is a note of caution to be sounded here. When you go back to the consumer testing and you look at the need for simplicity, if there's too much information on or around the dashboard, you start to worry that perhaps the key messages from the dashboard are being missed. So that's certainly something that we'll be thinking about in the future. Now, I just want to turn to Executive Officer remuneration because 1 July is coming up very quickly with this. You'd all be aware that late last year we released a consultation paper 219 on Executive Officer remuneration and systemic transparency and what it means to keep superannuation websites up to date at all times. And in that consultation paper, we were proposing a safe harbour of 14 days. The response, and we received all of the responses by early February, the response so far has overwhelmingly been in favour of a class order that provides a safe harbour. So I think I can fairly safely say that's where we're heading in our thinking. However, there are a few things and some comments that came back that I thought would be useful for you to know about. There is a clear preference for business days as opposed to just a flat 14-day period. There's also a preference that rather than having 14 days in most cases, but then 7 days for significant event notices and immediately for PDSs and FSGs, there is a clear preference that everybody would like to see a standard set of days right across the requirements. We also got the inevitable feedback, particularly in relation to Executive Officer remuneration, that you would like it to align with listed companies and the 300A requirements. I did start by thinking that that is something that we would not tackle, that that's a big policy call really for government to make. However, as we've looked at it further and we've seen the submissions that have come in, it is something we are actively considering and speaking with Treasury about. So while I can't make any promises right now, I do want you to know that the feedback that you gave us has certainly been considered in that regard. So you may see more of a move perhaps to a type of listed company annual reporting framework, say 3 to 4 months after a financial year end. In the consultation paper, we outlined the next steps, and I think we said in that we were anticipating a regulatory guide in March, April. I realise it's nearly the end of March now. I think that timeframe is more likely to be April, May, but I think we are heading towards a regulatory guide and a class order that provides that safe harbour we were discussing in the consultation paper. I do just briefly want to talk, just before we move on to ASIC's approach, some of the reforms that are not yet with us that were mentioned in the government's discussion paper, and of course I'm talking specifically about the choice product dashboard and portfolio holdings disclosure. And obviously the start dates for those were subject to some discussion in that particular paper, and we're waiting to see exactly how the government would like to move on this. Obviously one of the options might be that ASIC does a class order to delay those dates. You'd probably be aware that ASIC is quite a keen supporter of the portfolio holdings disclosure regime, and many of you will have heard our chairman speak on this topic previously. We're also quite supportive of the regime applying to managed investment schemes, which may take some of the pressure off trustees in terms of having to look through and get underlying fund data. We're less fond of materiality thresholds. But however, in looking forward 5 years, as we were doing in preparing this presentation, I think portfolio holdings disclosure is an interesting example or an interesting case study of where we might be in 5 years' time. I don't doubt for a moment that many of the submissions that will have been received in relation to the government's discussion paper will have suggested abolishing the idea of portfolio holdings altogether. I don't think portfolio holdings is going to go away. I think it will end up being one of the many pieces of disclosure to consumers and to the market that will be a legacy of stronger super. And there are a number of reasons for this. I think it's partly that we now live in a global economy and many other jurisdictions, certainly the jurisdictions that we benchmark ourselves against, such as the US, are already in the portfolio holdings disclosure space. Also, a number of the objections that I hear about portfolio holdings disclosure when we're talking to trustees are less about portfolio holdings disclosure per se and more to do with how it should look. So we're already talking about detail as opposed to whether it should exist or not. The other thing to note, and there will be people in this room who know this, there have been people who have already moved into the portfolio holdings disclosure regime, or at least a version thereof. And I think once you start to see the early adopters moving, it's very hard to make a case to say that it can't be done. So if there is one message from this, I think please don't think that some of these transparency measures are going to go away. I certainly think in 5 years' time when we look back on this, they will be with us in some form or other. Now, I'll move on to ASIC's approach. just in terms of the way forward and the work that we're doing at the moment, you'd be aware that we have a facilitative compliance message, and that's in place until 1 July this year. However, it doesn't mean that we won't do any review work at all. And in fact, I've already mentioned that we're looking at product dashboards. Partly that's to see whether we need to issue further guidance. So as I say, it's not necessarily a sinister exercise in trying to generate stop orders or anything like that. We also expect to see breach notifications. We know that when the industry is under pressure, the IT systems are under pressure, things go wrong. We're not unrealistic about this, but we do expect that there will be some breach notifications that let us know what's going on in the businesses at the moment. I also think that we will continue to work closely with APRA, and we certainly have all the way through in a policy sense. And the letter that Helen referred to that went out last Friday in relation to 29QC is a good and tangible example of this. We also have a number of relief applications on foot at the moment, and some of these applications are now getting to the really interesting implementation issues. I did want to talk a little bit about relief applications because I'm conscious, obviously, that we have a moratorium on reform, particularly while the financial system inquiry is underway. And I know there's been some concern that ASIC won't make any class orders or give any relief while that is on foot. That's not the case. I don't think that you will see ASIC undertaking major policy changes, but certainly where there are legitimate implementation issues, where there are genuinely situations where people have been affected in unintended ways, we will of course consider relief applications. However, can I please encourage you to apply early and also to give us good detail about why you need the relief in order for us to consider these matters. I should also mention, because I'm sure this will come up in a question, that the class order about long-term performance reporting, we have received a request to roll that over from an industry association, so I do expect that that will be looked at. You'll probably see an answer to that in April, I suspect. I want to touch briefly on advertising as well, and I know this is a broad set of areas we're covering here, because advertising continues to be an area of focus for the Commission. Yesterday I was at the ASIC Forum in Sydney, and I listened to our Commission members, and Greg Tanzer in particular, talking about our focus on advertising and our interest in exploring all of our powers, including the powers under the consumer law, which includes things like infringement notices. He also mentioned yesterday, and I thought this was interesting, our particular concerns with comparative advertising, and that's not just in the super space, that's more broadly. So you will have seen, no doubt, recently that there have been some infringement notices, including in relation to SMSF promoters who are comparing themselves with APRA regulated funds or who are making claims about how low cost or whether they charge no fees. In fact, there were media releases issued last week on these topics. So advertising continues to be an area of focus. So looking forward again, where do I think the industry will be in 5 years' time? I think a lot of the stronger super reforms that have started will be finished off, even if they are in a slightly modified form, and that might apply, for example, to things like portfolio holdings disclosure. I think we are now on the transparency track, and I think that's the direction we're heading in. There will obviously be new ideas from FSI, and if there is one thing that is certain in this industry, I think certainly change is the one certainty. I think that the good trustees will be the trustees who are flexible and adaptive and can cope with the changing regulations and with the changing needs of consumers as we move on and into the next 5 years. And in fact, I think the challenge for the regulators is to be as adaptive and flexible as you are. Thank you.